Okay, I've started recording. So let's start the class. Okay, so today's agenda is budgetary control and encumbrance accounting. Okay, so we'll be touching upon the topics like why do we load budgets in the system, components of defining budgets, enabling encumbrance accounting, and the features of budgetary control and encumbrance accounting. Right. So Sneha and Shrikant, so what do you know about budgets? I mean, in a very general sense, what is your understanding of budget? What do you mean by budget? Sneha,
Like
Planning,
planning to spend our income revenue.
okay, okay, fine. Shrikant, what about you?
planning about what we have
What you have in the sense?
in the sense if we have money, we are budgeting according to it. So,
Correct. Okay. Okay. Good. Okay. Yeah. Correct. So, anyways, first let's understand what budget means. See, budget is a financial plan or a financial forecast, meaning something that you predict or estimate a future event, right? So that is basically what a budget means in a very general sense. So now, what is a company budget? Now, see, every financial year, the company forecast how much income or expenditure they should be targeting for, right? So this drives the company to a particular direction because the budget helps them to identify how much income they want to generate in the next financial year. And it also helps in predicting the amount of expenditure that they incur to generate that particular income. Okay, somebody is joining. Shankar sir is joining. 1 second. Yeah. Okay. Good evening, sir. Can you hear me, Shankar sir? Hello.
Shankar sir?
Hello. Hello. So I think I'll just continue with you here. Yeah.
Yeah.
So basically, the company sets income and expenditure targets through budgets. Okay. So at various stages of the financial year, this targeted income and expenditure is compared with the actual income and expenditure. Okay, as the financial year moves. This is where you get the variance report. I was talking about variance report in one of the classes, remember, where you have your projected income and expenditure and the actual income and expenditure that you have earned and incurred. So the difference between that is your variance report. So which helps the company to plan their budgets in a more efficient way for the forthcoming or the next financial year. Okay, so basically budget is a decision making tool for the management to react and see how they should revise the budgets and their strategies or plans towards achieving their targets as per the market trends, right? So we all are good at budgeting in our personal lives, isn't it? See, at personal level, let's say you want to go on a holiday. Okay, so do you just get up and go to the airport, buy the tickets and travel to your holiday destination? Does anybody do that? No, right?
No, ma'am.
You know, right? So you plan very well in advance, right? Say a month or say a few months in. So there is a lot of disturbance. Yeah, sorry. Okay. So basically you plan, well in advance, say a month or a few months in advance, because you want to get the best bargain for the air travel and the hotel bookings and all that, right? You also plan your expenditure for your holiday trip, like how much you want to spend for your meals or your sightseeing expenses and your local traveling, like your taxi fares, etc. Right? So this is what is budgeting at a personal level. Now, coming back to the business, companies always make a budget before the financial year starts. So this is called as yearly budgets. Now moving on to what budgetary control and what encumbrance accounting is. Budgetary control and encumbrance accounting within the Oracle Financials Cloud provides a complete solution okay, which integrates planning and budgeting. It proactively controls the spending across the entire procure to pay P2P, your P2P transaction life cycle. Okay. Budgets also helps in streamlining the financial process, okay, with encumbrance, carry forward, and exceptional reporting and analysis. See, encumbrance is in accounting refers to restricted funds inside an account that are reserved for a specific liability. Now, I will be explaining about encumbrance in detail in the upcoming slides. Let us look into why do we load budgets into system. Okay. So the key advantage of loading budget in the system is that we can always check how much we planned to spend a particular expense before we actually commit for the expenses. Okay, say for example, the procurement department buys raw materials or goods for the business from the supplier. Then the procurement department sends the invoice to the payables department, right? Then now the payables department says it doesn't have funds to pay the suppliers. Now, can we tell the supplier that we don't have funds to pay you? Can you do that? When you order, no, you can't do that, right? So this is where the company's budget plays an important role. It becomes the company's responsibility to make all the payments to its suppliers, right? That's why the budgeting should be done before incurring the expenditure or committing the expenditure. Okay, so now the question arises, why do we load the budgets into the system? So the answer to this is, from the system's perspective, when we load or enable the budgetary control into the system has the ability to give us a decision-making opportunity before we incur the expenditure while we are creating purchase requisitions or your purchase order, or at the time of payable invoices, or during your journals creation. Okay, so the right place to check the budget is at the purchase requisition level. Okay, so because purchase requisition is an internal document of the organization, whereas a purchase order is an external document. But still, as long as a purchase order is not issued and the organization doesn't have the budget for it, you can still stop the purchase order, right? So basically budget helps you at the requisition level. Now, if you, when the requisition is raised, automatically when you put a budget control, it will check and tell you, okay, whether you have the funds, to meet that, requisition or not, whether you will be able to pay the supplier that particular amount for the requisition that you have raised, right? So whenever a purchase requisition is created, if you load a budget into the system and we enable the budgetary control, the system will check whether the organization has enough budget or not. And depending on the budgetary control, it will stop you from creating a requisition, or it can give you a warning, with information for a decision-making purpose. So whenever a purchase requisition gets converted to a purchase order, whatever the budget is, the system will block the budget, because the requisition is not an expenditure. When you're still in a requisition stage, you're just raising a requisition. That is not an expenditure yet. Okay, expenditure is when we spend it. Okay, so requisition is an internal document. So every stage, the system blocks the budget. And when the requisition is converted into a purchase order, the system reverses the budget which it had blocked, and then the system will block at the purchase order level. So basically, right, first is the requisition, purchase requisition level, then you move on. Once your requisition is approved, then you move on to your purchase order, right? And then once the purchase order is approved, you come to the invoice payment stage. So these are the basically stages in a P2P cycle, which I'll be explaining it to you in detail when we start with the Oracle accounts payable option, right? So, but this is in general, this is how it goes. And you can actually enable budgetary control at each of these stages, so that you have a check over there, right? So till now you're able to follow, right, what a budget means and how you can control a budget. Shrikant and Sneha, yeah.
Yes, ma'am.
So, okay, good. So at the purchase order level, the budget is blocked, this becomes an obligation. Okay, till now this was at a purchase requisition stage, it was a commitment stage. You're committing to something. Okay, fine, you're raising the requisition saying that okay, I once the order is placed, I will pay. So that is a commitment stage. When it comes to your purchase order level, that is an obligation stage, wherein once your purchase order is approved, you have to, it's the company's responsibility to make the payment once it receives the goods and services, right? Okay, so this was it. And then so as I said, at the purchase order level, the budget, okay, these are the things, right? Okay, fine, done. So let's move on to the components of defining budgets. Okay, so fine. See, we need to define 3 core setups, okay, which are the budgetary controls, the budget calendars, and the control budgets. Now, and then we have to even assign a role for a budgetary control to the particular user. You remember, right? Once we, when we started implementing the project, we first have to, create a user, then you start assigning the role for the user, right? And then you give a data access. Okay, same process.
Excuse
yes,
me, madam. Sorry
yes,
to
sir.
interrupt.
Yes, sir.
Sneha, Srikant,
Yes, sir.
what is the navigation to create assign a role to the user? Where we go?
Navigation, navigator,
Navigator tools,
security and
security
tools, security
console.
console.
Yeah, very good, very good, very good. Oh, ma'am, you can continue.
Okay, fine. So as I said, we have to assign a role of a budgetary control to the particular user, and the same user should be given the data access for a particular control budget against which the user can load the budgets. So these are the few components. Once defined in the system will be ready to implement budgetary controls. Now Setu sir will actually walk you through each and every component and the setup process in the practical classes, right? Okay, so let's continue with each of the components. So basically the budgetary control is enabled at the ledger level or the project level. So the organizations, say for example, which implements the project portfolio management offering, they can use this functionality of enabling the budgetary control at the project level. So if everything is project driven and they maintain budgets in the projects, they can, then any transaction that happens and the project code and task number is given, the system will automatically check the budget against a particular project, which is maintained in the project portfolio management offering. Okay, so you can also define budgetary control at the business level, business unit level as well, okay, for any particular business function. So now once you define budgetary control, we need to define the budget calendars, right? So if your budget calendars are same as a financial calendar, for example, financial calendars are period based, right? So, and these periods are typically monthly. So if your budgetary controls are also monthly, for example, an organization has set a budget for travel for its employees, which is rupees 10,000 every month. And for the year, it becomes 1,20,000 rupees. So now if I want to make sure that people do not exceed more than rupees 10,000 a month and the organization uses a monthly calendar, then we need to define an additional calendar. We need not define an additional calendar. We can use the financial calendar as it is for the budgetary control. But now let's say the monthly budget is defined, but the organization wants to control it on an yearly basis. Now let's say for example, the same example of travel example that I gave you, wherein the yearly budget is rupees 1,20,000 and the monthly budget is rupees 10,000. The organization does not care how much it spends monthly, as long as the yearly expenditure does not exceed the budget of rupees 1,20,000, right? So it can even set up a yearly control wherein you can even spend the whole of 1,20,000 in first month itself. When you give, you getting my point here? Are you clear? See, in the monthly budgets, when you give a control on a monthly budget, there you cannot exceed the monthly budget of 10,000. Suppose if your requisition is crossed above 10,000, you will get an alert. It will get blocked there. But in an yearly budget, what happens? The company is not bothered whether you are spending 1 rupee in 1 month or say 20,000 in 1 month. So basically, you should not exceed your yearly budget of 1,20,000. Okay, so this is the difference between your monthly budgets and your yearly budgets. You people could get that point?
Yes, ma'am.
Yes, Shrikant?
Yes, ma'am.
Okay. So some companies want to use the budgetary control on an yearly basis, okay, which is more easy to implement because it is very difficult to predict the expenditure on a monthly basis. So once we define the budgetary control and the budget calendars, we next move to defining the control budgets. Okay, so what is this? This is one where we actually define what type of control you want to put in the system. Now, for example, if a user exceeds the budget, he will get a warning, but the system will let the user proceed and continue. Okay, this is basically, and you're just getting this is a soft control budget wherein you're just getting a warning and an alert, but still it will allow the user to proceed with the further transactions. Another case will be if the user exceeds the budget, we'll put a hard control and stop the user to do any transaction. Okay, so there is another option also wherein the system keeps recording in the background. The user will not get any warning or alert, and it's only for the reporting purposes. So you can define on how what kind of a control you want to give into your system. Depending on the company's decision, you can give a soft control or a hard control. Okay, so this is basically the control budgets. At this level, you'll be defining the level of control for the budgets. So in order to do all of the above, one should have a budgetary control role. Now, this is the role generally given to a financial planner or a budget manager or a financial analyst, right? So this role gives the user the access to budgetary control functionalities like defining the budget controls and all that, right? And then as a setup, after assigning the roles, the user should be given the data access to control those budgets. So in the data access, the user is allowed to specify a budget against a particular control budgets. So once we have everything in place, then we can load the budgets in the system. Okay, so these are the basic components for defining the budgets. So till now, is everything clear as to what budgetary control is?
Ma'am,
Yes,
just Srikant,
Sir.
Sneha,
Yes,
if
sir.
the second slide you can see, no, second slide, this
sir.
slide, ma'am has
Yes, sir.
mentioned this setup budgetary control, setup budgetary calendar, setup control budgets. What is that? What is that? Setup budgetary control. See, under defining budget, ma'am is going, ma'am is telling theoretically. Theoretically, she is telling that these are all the sequence of steps for defining budget. What is that? Ma'am is the word setup, but actually in practical, what we call
Create budgetary controls.
create budget. But what is that? What is called creating budget? What is called? See, for example, I will tell you, create budgetary control. A ma'am told set up budgetary control. Okay. That is called, you are telling create budgetary control. What is that? What is it called? I told you, no. Create chart of accounts. Create, under chart of accounts, create value set. Create chart of account structure, chart of account. So what is that? What is the word I used? What is the word? It is an activity. What is that? What is that called?
Define.
No. What is that activity?
Assign task.
Okay. Excellent. Good. That's why I want to check with you. Okay. Very good. Who has told?
Sir.
who told? Shrikant. Who told that?
Srikanta. Okay. Good, good, good. Okay. Ma'am, you can continue.
Yes.
Sorry.
No, no problem.
Just
No problem. Yeah. Good, sir. Good, sir. Yeah. Okay. So, anyways, let us see what is the difference between a budget and an encumbrance. Okay. Okay, fine. A budget is a list of anticipated expenses, right? So, to make your anticipated expenses equal to your anticipated income is called budgeting, right? So say suppose you are earning certain lakhs of amount by the year end, okay, and you want to buy a plot or a flat or something. So these are your estimated income, is your total salary that you'll be earning by the end of the year, right? And you're planning to buy a flat, meaning your estimated expense. Okay, fine, you're going to budget yourself, okay, fine, to buy a flat. So you're going to plan accordingly. You might even start saving more amount every month, okay, so that you can go and buy the flat there. So this is basically, a budget is a list of anticipated expenses. To make your anticipated expenses equal to your anticipated income is called the budgeting, right? Now, what is encumbrance? See, encumbrance, in other words, is known as commitment accounting, okay, wherein encumbrance is a portion of a budget which is set aside for spending. So encumbrance is an extension of budget, all right? When simply put, budget is a kind of reserve kept for future purpose expenses for known expense overheads. You know that you're going to have this much of amount. These are going to be the expenditure, and you're catering for that expenditure for the next financial year. Wherein encumbrance is a kind of reserve kept for future purpose expenses for unknown expenses or unexpected expenses. Okay, now see, in a manufacturing company, say you are manufacturing 500 cell phones, okay, that is your basic target, okay, for a financial year. So you have set a budget, for this, okay, these many lakhs, say around 50 lakhs of rupees that you have set for this financial year, and you'll be using for that manufacturing of 500 units of cell phones. Now, where there's encumbrance coming to picture. Now, suddenly what happens in the middle of the year, you get an order of extra, say 600, manufacture. You have to get an order of manufacturing 600 more units of cell phones. Now, what will you do? You would have just catered for 500, or say maybe you can still cater for 100 more extra cell phones, okay, with the allocated budget. Now, suddenly you have got this order and you do not want to miss out that order because it's a great opportunity to expand your business, right? So in that scenario, what the company does is it would have, kept an encumbrance reserve, which is unforeseen. Now, this is an unexpected event which happened, right? That you suddenly got an order of 600, manufacturing for 600 units of cell phones, right? This is an unexpected event which occurred. Hello?
Yes, ma'am.
Yeah. Okay, fine. So, so this is an unexpected event. So the company will keep a reserve called as encumbrance reserve for an unexpected event, so that it can spend, it can take out the amount from that encumbrance reserve and utilize it for the extra order that it has got. So you got my point. Budget is an a future reserve for known expenses, whereas encumbrance is a future reserve for unknown expenses. So you're getting that difference between what a budget and an encumbrance is, Sneha and Shrikant?
Yes, ma'am.
Okay, fine. So let's move into enabling encumbrance accounting. So as the formal definition goes, an encumbrance refers to restricted funds inside an account that are reserved for a specific debt or a liability in the future. Right? Okay, like creating a PO, like suddenly you got an extra order that I just gave an example, or keeping enough funds for your payroll. Suppose now that you got an order and you have to employ more number of people to complete your order, so you'll have to spend give them salaries also, which was not in your budget. So okay, so but encumbrance reserve will take care of that. Okay, so those are the examples for encumbrance. Now, before we understand what encumbrance accounting is, let us understand three terms, which is the encumbrance, commitment, and the obligation. So as I already said, encumbrance, this is your pre-expenditure, okay, such as a purchase requisition or a purchase order, which will lead to a charge against an account. Okay, then comes the commitment. So a commitment means wherein you make a journal entry to record an anticipated expenditure as indicated by the approval of a requisition. Basically, see, it's an encumbrance you record when you complete a purchase requisition. So the requisition amount is called the commitment. Okay. Then you come to the obligation. This is an encumbrance you record when you turn a requisition into a purchase order. So basically your purchase order amount is the obligation, which you have to pay to the supplier. So basically encumbrance accounting is avoiding budget overspending by showing open commitments as a part of projected expenses. Now encumbrances are important in finding out how much funds are available as a projected expenses tool. Now, commitments are obligations for future expenditures made, which are made for an employee, like salaries, as I just gave you an example. No, suppose if you get a new order which you had not anticipated, you have to pay, you have to hire more employees and pay salaries, like salaries to them, and pay more, you have to order more raw material, so you have to, you know, pay for your suppliers as well. So commitments are tracked to help departments forecast their expenditures so that they do not exceed their budget which are available. Okay. So when we use encumbrance, we get answers to two questions, which are the how much do I have to spend, or alert me if spending too much from allocated budget. So funds available is equal to budgets minus your actual means your actual expenditure which you're incurring, okay, and minus your encumbrances reserve. All right, so budget is always unaltered and encumbrances is reversed when matching to AP invoice. So whenever you create a takeout fund, when you create a requisition or anything, when it gets approved to a purchase order, you have to reverse that journal entry, or else your trial balance will not, your debits will not be equal to your credits. Okay. That is it. So the benefit of the encumbrance accounting feature is the ability to have the system control the expenditure budget from the general ledger, reducing the risks of potential expenditure. Okay, fine. Then you have the reservation of funds, which is the encumbrance. Okay, so the purpose of the purpose of encumbrance is as follows. It's basically to avoid overspending of the budget. Sorry, one second. Yeah, and to facilitate effective control and consumption of budget by pre-allocating budget amount. Okay, so encumbrance is a commitment to pay in future, although the goods or services have been ordered. However, they have not been received yet, right? So for a company, encumbrances reserves the money for paying for goods or services in the future. So that amount is called encumbrance, and the amount will become expenditure when goods and services are received. Okay, so let me give you an example in the Excel sheet. So we'll just move to the Excel so that you will get a better understanding. Okay, see, as I just mentioned in the PPT, the commitment and obligation, right? So these are the three stages of encumbrance accounting in a procure to pay process. So we spoke about the commitment stage, okay, which is creating and approving a purchase requisition. Then you come to the obligation stage, which is creating and approving a purchase order. And final is the actual stage, where you create and approve receipts and you pay for your invoices. All right, so encumbrances flow throughout the procurement process, that is from the intention to buy goods or services to procuring and receiving the goods or services, and to the final step of incurring the actual expenditure and making the payment. Okay, so these are the steps which are taken in the procure to pay process. Okay, till here you understood, right? Do you have any doubt till here? Sneha and
No,
Shrikant?
ma'am.
Okay. Shrikant? Okay, fine. Okay, so now
Ma'am, in that before slide, there was a line like budget is always unaltered.
correct.
So we will
Yeah.
be fixing up a particular budget for the
Financial year. Yeah.
okay.
Because you usually make a budget for a financial year, right? As I gave an
Yes,
example
ma'am.
of the travel expense. Okay.
Yes,
So
ma'am.
yeah, so you know that this is because you already plan everything in advance, right? So this is like as I gave an example for your manufacturing of cell phone units, right? So you have planned for manufacturing of 500 cell phones, okay? And you could even cater for 100 more in case if there are any defects which happens and all that. So this is, you have already budgeted, you have allocated funds, you have made your reserves available, and you know how much raw material you need to order from your suppliers and all that. So everything you have budgeted. Wherein encumbrance is for your unknown future expense.
Expenses.
Yeah.
Yes.
So okay, as I gave an example of your
Yes,
sudden
ma'am.
order. Okay, you got it. Okay, fine. Shrikant, you're clear with it?
Yes, ma'am.
Okay, so next let's take an example of a business flow. Okay, so here is just an example of a budget allocated for expenditure, which is 10,000 rupees. Okay, budget remaining is appropriation, is the fund which is allocated, okay, for your budgets. So this is called as appropriation, right? And you know the commitment, obligation, and the actual stage. Okay, so let's see how the business flow works. See here, the budget allocated for expenditure is rupees 10,000. Okay, then you raise a purchase requisition for 2,000 rupees, and then you send it for the approval. Okay, so here your PR, which is your purchase requisition, gets approved. Okay, so this is your commitment stage. Then your appropriation gets reduced by 8,000 rupees. This is still happening, your backward. Okay, this is your internal entries which are happening. All right, your final entry which goes to your GL is your actual expenditure which is incurred. But this is still in the requisition stage, which is your internal document. It is all happening in the internal phase still. Okay, then after your PR is approved, the purchase requisition auto creates the purchase order. Okay, wherein it is again for 2,000 the purchase order would be created, and your appropriation is left with the budget, remaining amount in your budget is 8,000 rupees. Now in between what happens is your purchase order value changes from your from rupees 2,000 to 2,500. Suppose if you want more raw materials or something, in the real time scenario, all these things happen. Suppose you need more raw material for something, your PO order automatically changes. So here it is changed from 2,000 to 2,500. So at this stage, what happens? This revision will happen, and then it goes to a PO approval stage. Okay, wherein your approver approves it, and then your this entry for requisition gets reversed, which I'll be showing you in the next sheet. Okay, so then once your PO is approved, okay, your purchase order amount will become the obligation. Okay, which is of 2,500 rupees. Okay, and then your invoice that is received by the supplier is matched against your budget, and 2,500 will be released for the payment. Okay, so this 2,000 will get reversed. Okay, because you have to set off the amount, right? So that your trial balance is always equal. Your debits and credits should always be equal. So this is your actual expenditure that you have incurred, and this payment will be made to your supplier. Okay, so any doubts still here?
No, ma'am.
Okay, Shrikant, you're also clear?
Shrikant, Purida? Purida?
Okay, fine. Yes, sir, you want
okay.
to add anything, sir, here?
Nothing, ma'am, just one second.
No problem, yeah.
Shrikant?
Sir.
Shrikant, purchase requisition, purchase order இருக்கு இல்லையா?
ஆமா சார்.
Purchase requisition இப்போ suppose ஒரு ப்ராடக்ட் இல்லைன்னு வச்சுங்க. ஃபார் எக்ஸாம்பிள் ஒரு கம்பெனில ஒரு ப்ராடக்ட் இல்லைன்னு வச்சுங்களேன், இன்வென்டரி டிபார்ட்மெண்ட்ல என்ன பண்ணுவாங்கன்னா, தே வில் ரைஸ் ஏ பர்ச்சேஸ் ரிக்வசிஷன், ரிக்வெஸ்ட் போடுவாங்க. தே வில் ரைஸ் ஏ ரிக்வெஸ்ட் பர்ச்சேஸ் டிபார்ட்மெண்ட்டுக்கு ரிக்வெஸ்ட் போடுவாங்க, எங்களுக்கு இந்த இவ்வளவு குவான்டிட்டி வேணும்னு. அது பேர் தான் பர்ச்சேஸ் ரிக்வசிஷன். ஓகேங்களா? இன்வென்டரி வேர் ஹவுஸ்ல இருந்து போடுவாங்க இல்லையா? இன்வென்டரினா ஸ்டாக் மெயின்டைன் பண்றோம் இல்லையா? அதுல இருந்து என்ன பண்ணுவாங்க, அந்த பர்ச்சேஸ் ரிக்வசிஷன் என்ன ஆகும், இவங்களுக்கு போகும், எது பர்ச்சேஸ் டிபார்ட்மெண்ட்டுக்கு. பர்ச்சேஸ் டிபார்ட்மெண்ட்ல போயிட்டு பர்ச்சேஸ் டிபார்ட்மெண்ட் என்ன பண்ணுவாங்க, வெண்டாருக்கு அதாவது சப்ளையருக்கு பிஓ ரைஸ் பண்ணுவாங்க. எது பர்ச்சேஸ் ரிக்வசிஷனை கன்வெர்ட் பண்ணுவாங்க, பிஓவா கன்வெர்ட் பண்ணுவாங்க. பிஓனா பர்ச்சேஸ் ஆர்டர். ஆமா, பர்ச்சேஸ் ஆர்டர் யார் மேல போடுவாங்க, யாருக்கு இஷ்யூ பண்ணுவாங்க, சப்ளையருக்கு. அதாவது இந்த மாதிரி எங்களுக்கு இவ்வளவு குவான்டிட்டி வேணும்னு சொல்லிட்டு வெண்டாருக்கு ஒரு பர்ச்சேஸ் ஆர்டர் ரிலீஸ் பண்ணுவாங்க. ஓகே, அது இஸ் ஏ பைண்டிங் கான்ட்ராக்ட் பிட்வீன் தி கம்பெனி அண்ட் தி சப்ளையர். ஓகேவா? சோ அது பர்ச்சேஸ். மேம் P2P சைக்கிள் எடுக்க போறாங்க மண்டேல இருந்து. சோ அது உங்களுக்கு இன்னும் கிளாரிட்டி கொடுப்பாங்க, ஜஸ்ட் உங்களுக்கு இன்ஃபர்மேஷன் கொடுப்பாங்க. மேம் யூ கேன் கண்டினியூ.
Okay, fine. So let us look into each scenario. Okay, like in the purchase. Yes, sir.
2 minutes
yes, sir.
Is there.
Okay, sir.
So
So,
accordingly,
yeah, so I'll finish this purchase requisition, then we can.
Yeah. Sure.
Okay, yeah. Okay. So let us take an example wherein the budget or your appropriation was created for 20,000 rupees. Okay. Now let's see how these budgets will be used and encumbrances created or liquidated. Liquidated meaning basically the closure of the accounts. Okay. So that, as I mentioned, your in the trial balance and your financial statements, the debits has to be equal to credits, right? So when you're creating your encumbrances journal entries, you have to set off. You basically have to liquidate that so that your balances are always equal. Okay, this. Okay. Anyways, sir, Shrikant is not well versed with the journals and all that, sir. So is it okay?
Yeah. Correct only, but we have to explain to him, no? Sneha ma'am, உங்களுக்கு கொஞ்சம் தெரியும் இல்லையா?
Yes, sir.
உங்களுக்கு journal entry தெரியும் இல்ல, டெபிட் கிரெடிட்?
Yes, sir.
Okay.
Okay, anyways, see Shrikant, in the when I share the Excel sheet, I have given these golden rules of accounting and the debit and credit rules. Okay, so you can just go through it so that you get a better understanding as to how these journal entries and which account goes where. So if you just do that bit homework, you'll be able to understand this encumbrance accounting as well as your P2P cycle, which I'll be taking in accounts payable module on option on Monday onwards. Okay, so I'll just request you to just go through the basic of accounting, and you can ask your mom also, right? I mean, she's an MCom, isn't it? So you can just ask her to help you out, so that from forthcoming classes from say Monday onwards, you'll be able to understand the whole process in a better way. Okay.
Okay.
So,